Hey, Sean, nice to see you, brother. Kevin, what's up? Emmanuel, how are you? All right, give it just a second to settle in. Get everybody settled. Hey, Lewis. All right, let's do this. Welcome to the webinar. It's Wednesday night. We are in the first week of February 2022. Time's a wasted, man. It's going fast. All right, Rule 4.41. Hypothetical simulated performance results have certain limitations. Unlike actual performance records, simulated results do not represent actual trading. Also, since trades have not been executed, the results may be under or overcompensated. Just keep in mind, this is the disclaimer to not lose money. Just be careful. Guard your capital. All right, welcome to the webinar. We got some new people in here. Happy to see you guys. See you popping in there. I won't call you out too early. Anyway, everything's cool. JR, don't worry about it. I'll talk to you about it later. I don't get upset. I'm thick skinned, brother. All right, so Happy New Year stuff. Jim Rohn, you guys know, some people are reading this book now. So motivation, first of the year, you're excited, blah, blah, blah. Now here we are. You got to form some habits. We're a month in. We're basing our structures off a 12-week year. I'm going to breeze through this stuff because you guys are over it, and I'm going to get right into charting tonight. Not going to talk about the book tonight. I've had just a handful of interest. I probably won't talk about it unless something changes dramatically in the next week or two. So if you guys are enjoying it, great. If not, we'll figure something out. You could just write me with your questions about it privately. All right, here we are, man. Got to do the calendar. See where everybody's at. Okay, just like this. Boom, boom, done. Okay, we're here. 2nd of February. Okay, we know February is a short month. Still got plenty of time to get it going, man. You got 1, 2, 3, 4.5 weeks in February, right? Which puts you here 5, 6, 7, 8, 9. You got 9 weeks left. That's a kid's grading period in school, right? And then you're coming into April 1st, and we're into spring, and then we're looking to get into the summer. So that's it. Mark off your days where you're at. Make compensations for non-farm payroll days. Make some adjustments. If you're working some kind of plan, whatever you're working, if you're working charting, okay, you need to be doing 5 charts a day, 5 days a week. 5 times 5 is 25. 4 weeks, it's 100 charts. That's the way you got to do it. You can't look at it and go, I need to do 100 charts. It's going to take me forever. No, it's like, my wife hates this, but I say it all the time. It's like, how do you eat an elephant? One bite at a time, man. And maybe it seems insurmountable to you, or it seems like too much work, but you just take one bite at a time, man. One bite would be 5 charts long, 5 charts short. That's it. Don't make too much of it. It's not that difficult. All right, so something that you've been around for a while and is struggling and want to know what to do is, these are the best skill builders that I have to offer in the business. I've done these and they're epic, man. So do the high-low drill. What is the high-low drill? The high-low drill is try to catch the high or low of the day in real market, real time. Don't use sped up bars. Don't use static bars. Don't click bar by bar. Try to catch the high or low of the day in real time using demo money with a 5-pip stop. Okay, so what's that going to do is you're going to try to get used to getting within a few pips or ticks of the high. So you'd wait for it to form a second leg and then try to snag it. Okay, then the other one that's difficult, this is hard, this takes a lot of time, but you don't have to sit in front of the screen the whole time. Try to do the always in drill. What does that mean? Okay, so we know price does pullbacks and swings. You could do it either on like an hourly chart. So you want to get short here. You want to get out and turn long here. You want to get out and turn short here. You want to hold it. You want to look for the consolidation, and then you want to exit the position. So use a 1 hour chart. Maybe you don't have to look at it that often. If you're sleeping, don't worry about it. Come back to the terminal. If you have a short position on, come back to the terminal and see where you can get out and go the other way. The idea is to be able to look at price and see where you are. And when you have an order on, you're trying to work an angle, it gives you a little more incentive, and it trains your brain to think how to get in and out. There's variations on this drill. You can like maybe put some money in, not real money, put some demo money in, take the position, and then try to figure out a way to average out of your position and go the other way. So let's say you sell here, or let's say you buy here, sorry, and it goes against you, and then you buy again, then it goes down, you buy again. So you would have 3 single lots open, and then you're looking for a retracement that would give you an aggregate exit, then you get out and you go short. And now let's say the market's going up, so now you're going the wrong way. You would try to find the pullbacks and aggregate in and then close the positions. Maybe set a 24-hour cycle where you close every day at 8 p.m., trying to figure out where you are. It's some way to engage yourself with price action. That's all it is. It's a simple drill. It doesn't really mean anything, but I guarantee it'll change your skills. Okay, you could do it the right way, or you could do it the varied way, or you could do the high-low drill. But you have to do some type of drill, man, and it has to be in real market conditions. All right, I'm going to get right into the charts tonight, man, because I got a lot to talk about. And you know when I get going, it goes to 8 o'clock quick. All right, pop quiz, answer the question. I'm going to mute for 30 seconds, answer it. All right, let's talk about this. Some getting it right, some getting it wrong. Okay, so we're looking at the auction levels in this, right? We're trying to put the book map levels onto this and understanding how we press, right? Okay, some of you are guessing 1, some of you are guessing 2. But let's talk about this for a minute. Okay, in order for this to be where it's sitting, there has to be a book map level right here, right? It has to be pressed this way, and the book has to be pressed this way. Okay, so in your mind, draw a box. Okay, so we have nothing right now. All we have is, at this point, before this bar breaks high, we have nothing. Okay, so price breaks higher and makes this becomes a swing point, which is labeled 1 here. Okay, it was a push down that failed. So this would be a failed sell auction, and the buyers won by taking out this level. Now, the false move is the first move of the day, right? We got our tracer right here. So we're looking for our anchor. We're trying to identify our anchor. So the anchor has to be set in before we could start looking at the auction levels as a trending move. So this would be leg 1 of the M, push down, right? And we're developing leg 2. Okay, so what happens here? The same thing I just drew over here, just transpose that crap over this way. So we need something to lean on over here to form the nadir. Okay, so price goes up, the dealers slap it back down. In order for this to validate sell side, it's got to take out this. If this doesn't take out this level and price goes back up but doesn't take out the high, we now have a new set of press, right? It's going to be here or it's going to be here. So this becomes the structural M, and in order to proceed, this level has to break this level because the book changes, right? So although it appears to be the lowest swing, this is the first shot at entry, and this is okay too. This is a safer play. But remember, once this order is gone, then they pull all the orders on the book and they move them over here. Then the orders are here, right? The orders are pressing here. Then once they break it, this shit's gone, and then they move it over here. So when price comes in, they tap this and they go back up. So now we're sitting between the auction levels, right? What's the auction level? We got a failed buyer's auction, which fails to take out. Let me erase the ink. I get too excited. All right. A failed buy side auction, which fails to take out the last two swing points. It's always the most current swing points that gives you directional move. And then when you look at the higher time frames, right, or you look back, right? So here we're judging this. This is the last swing point that came down. This is the last pullback. Now, what are the options here? If you're looking at this pullback, there's one of two scenarios, right? The dealer has to break above the previous swing auction that failed and turned. So then the option is test higher, or the option is test, take out the level, and test lower. That's it, right? Or stay inside the confines of the two swing points. And then you have consolidation, and I'm going to talk about that tonight. This is the reason I put this out in front is because this is exactly what I'm talking about tonight, how you can see what this looks like. So if he stays in between the two swing points, the swing high and swing low, then he's accumulating, and there's a different set of circumstances in there. This might run out from noon to 5 o'clock and then reset. Because remember, when this area holds and price moves higher, right, they put an order here, they put a block of orders here, they put a block of orders here, price can't get through, it breaks, right? Then you're looking at this swing point, price fails to take out. At this point, price fails to take out that. You still have buy side book. When they fail to take out the other swing high on the next move, now you got something, right? Now you're in between the two levels. They're pressing the book. They're here and they're here. This is the last swing point where sellers tried to take the book all the way past this level. They failed. Back up. Buyers are trying to take the book. They got to get past this level. They failed. Now you're in sideways consolidation. The next move down is the press here. They take out the press, and then that's the way it's going to go. Maybe not. They could tap into this area right here and fail to take it, and they can come back above here and go higher. It's always the previous swing points that adjust for the book, right? In this case, it's here and here. And if you notice, they rest on here, fail to take it, go higher, take the level, buy side book. They come back down, fail to take the low swing, buy side book. Wait a minute, fail to take the high book, flat print, scratch. If you're in something, scratch. They come back down, they take the level. Now we got anticipatory sell side book. Got to get something. You got to get a signal. You got to get a nice, maybe a vector candle to the low, and then maybe some kind of evening star formation on the second leg. Then you refine the entry and move it over. Okay? If you are more, I guess conservative would be the right word, is you can count this as all consolidation because this is yesterday's high consolidation zone, right? You could box this whole zone up and stretch it all the way out, and it actually would encompass both areas. So then you would want a clean take of this area and that area. But the most relevant area is the near side area in the book. This, as far as they're concerned, this was Asia. This was hours ago. I don't know the timing on this. But I'm looking down here now, 4:30. I don't know what GMT slot this is or what dealer this is. But it's always the most relevant swing, the closest near-term swing. And it's ask yourself, who's got the book? Okay. When you're in between levels, the book's neutral. Nobody has it. It's in consolidation, accumulation. No one has the book right now. Okay, but if you had to make an assumption, the last swing high, failed buyer's auction, the last swing low, failed seller's auction. I need someone to take a level, high or low, and then I got something, right? This would be the edge, and you could almost make the argument here that this is the wedge, right? Edge and wedge, and then you're going to get a pop out of here. Something about wedges, this is a horrible depiction or drawing, but something about wedges that's very interesting is that they fish flat and they taper. And when they fish flat on the bottom, that's usually the side they break. And if they fish flat on the top and wedge it this way, that's the part they break. Go look at it. It's historically in there. It's crazy. It's probably because they're hitting the same level, but they're hitting high, bringing it in, bringing it in, bringing it in, they break out. All right, let's get right to the charts. Hope that helped. It's kind of a gray area. Like both of those swing points are correct, but the nearest swing point to the most current auction is correct. Number 2 is the correct answer, but if you want to be conservative, wait for the break between 1 and 2 to take out both previous swings on a vector bar and then retest into that area. And you can use those 2 swing points as a zone. All right, so we're going to talk about microstructures. Here's what I want to do over the next couple of weeks. I want to make a little series about how the bars are structured, how the bars form together to form 1 minute, 5 minute, and bigger charts, and tie it all together using auction theory and hoping you guys understand order flow and what's going on. I'm not trying to sell any tools. I don't do that. You guys know that. I don't want you to buy a single thing. I'm not telling you to buy anything, and I'm not subliminally influencing you to buy anything. Do not buy another thing. The idea behind this is to understand what's going on in your mind. And when you see candles forming and when these values forming, you understand how to either hold, fold, or move on to the next trade. All right, that's what the point of this is. If you understand what it looks like behind the scenes from the back side of the screen, from the dealer that's feeding you what you see on the front side of your screen, if you understand what he's doing, then you'll be calmer in your trades and calmer in your approach. All right, so we're going to walk through the bars. This is a typical volumetric / ladder bar, whatever they want to call it. Okay, it's basically an order flow bar. So what you have here are these little areas are called cells. Each little block is a cell, not SCLL, CLL like on a spreadsheet, or CL like on a CEL like on a spreadsheet. Okay, if you notice the print on the side, this is what the candle formed like, and this is how the numbers fleshed out inside each bar. Okay, this piece right here is a term called POC, point of control. And this is remember I talked about this guy was brilliant. He took a volume graph and he flipped it on its side and he created areas on each bar, each chart, daily, weekly. It's incredible. So he took a volume graph, flipped it on its side, and made it in this instance applicable to every single bar, how the volume was flowing into it. And Standall did this a long time ago, and I read the book and it's horrible. Don't. Just trust me, it's easier to look at some slides that I wrote for you after reading the book. All right, so obviously there's some basics, but there's some new people who want to cover every bit of it. Every bar has orders coming into it from the order book. Those orders displayed in a ladder style, side by side, I just showed you. To allow for the spread, they're actually diagonal, and I'll go over that in a second. The sellers are placed on the left side of the bar. The sellers are here, which to me feels like it's supposed to be the buyers, and the buyers are here. And the way to remember that is the sellers are on the left, buyers are on the right, because the sellers are hitting the bid or buy side, and the buyers are lifting the offers or sell side, right? If someone's offering you a price and you accept it, you're buying, you're lifting it. If someone's trying to sell to you, right? I don't even know what to say. I hope it makes sense. Okay. But this to me seems like why the bars are printing backwards. Sellers are hitting the bid on the buy side. The buyers are lifting the offer on the sell side. I don't know if that helps, but anyway, that's where we're at. Okay, so the spread, right? The spread is diagonal. So this was no orders executed here, and 72 went into 177. And obviously there's trap traders. Only 72 out of the 177 were absorbed. The balance is stuck, the high side of the bar. So in instances where there's 2 or 3 pip spread, so here's what happens. You have this number, let's say you're executing at this number and you're paying a 2 pip spread plus commission. So it would go 1, 2, and you would pay that price. Okay, the dealers pay even money. They pay this right across. They pay nothing. They have no spread. So if they want to get an order off at 08, they're going to get it off at 08. If you want to get an order off at 08, depending on the pair, the dealer, and what it costs, you got to pay 08 plus 2, you're paying 10 plus a commission. So 08 plus 2 at 10 bucks a tick is 20 bucks, and $10 commission is 30 bucks to do business. Round turn 60, right? That's how they do it. That's how it's calculated. So the sells, right? If you get a 5 pip spread, you just count up. There's the order 1, 2, 3, 4, 5. You're paying that. That's why when you get in the order, your order seems to jump and you feel like you got hosed. That's why, because the spread's on there. If you use limit orders, you get filled very close to the high or low, but there's still a cost of doing business. Okay, so that's how the spread's calculated. That's how the dealers adjust and make some money on you. All right, so talked about that. All right, I just said the spreads are calculated on diagonal. Okay, the broker is most likely paying straight or one sell markup. If he's a boutique broker and he's buying from a reseller, like if you guys remember FXCM for a while, they were white labeling a lot of people around in the country. That's why when they went under, all those places closed. One place that I really liked was a good brokerage house was ATC. They went under when FXCM went under. So they're white labeling. So they're the main broker. They have all the money and they're putting up their name and backing up these small firms, and they're giving them basically a white label feed, which means they give them an MT4 platform and they rebrand it. And that's how you're able to have these other brokers that don't really have any money or any backing. They're white labeling it. And what happens is FXCM pays even, and then they might say, okay, you're going to pay 1 pip spread on all your sales and half of the commission, and then they say, okay, we'll do that, and they get to have a firm. All right, so 10 bucks a pip. If you're paying 2 or 3 pips, 5 pips, that's the cost of doing business. It doesn't feel like you're paying anything, right? Because you're clearing the spread, and then you don't feel like it comes out, and then you're hitting your profit. But when you lose, if you have a 10 pip stop and you got a 5 pip spread, it costs you 15 to exit the trade, and then maybe 10 bucks commission. That's the stuff you have to understand. All right, so everybody knows there's demarcations on a bar, right? The main ones: open, high, low, and close. All right, that's significant for the type of prints that we have and the way things paint. All right, but the new terms, and some of you have been around and heard them a little bit, is a thing called a POC. It's called a point of control. And what that is, it's the highest volume of orders executed at price. Okay, who cares, right? All right, Steve, so what? A bunch of orders came into the bar. Well, it matters because it's kind of a support or resistance area on where the next open bar will paint. Okay, so Carr uses a 1/3 rule, and he's pretty damn accurate with that. It's pretty close to what reality is. The POCs are usually a third off the high of the bar, a third off the low of the bar. Then you add a little wick in there and some spread, and we'll give you an area of execution on a bar, like an overlap. We know that candles don't go straight up. Very rarely do they go straight up on top of each other. They don't stack straight up like a train car, right? The bars don't print like this. Okay. Then there's a thing called VWAP, and I talked about the 50 EMA, but everything that measures price is weighted by highest volume traded, points of control, and volume weighted average price. So what that is you take the closing price of a bar, right? It's not the open, high, low, close on a candlestick. It's the closing price of a bar averaged by all the volume that came in. And if it's averaged out, it would give you a piece of the bar of where price average balanced. Does that make any sense? It's kind of hard to understand. So they take every one of these cells here. They take every one of these cells of money. I know it's hard to see. It's hard to get a picture of that and spread it out and make it on a slide. But they take every one of these cells and they average out, and they decided that this was the average weighted price of a bar. So it's basically a moving average, volume weighted average price of what the candle should close at right here. That's what that is. Why is it significant? Because if price is trading above volume weighted average price, the anticipatory next bar should paint higher. If it's trading below, it's going to paint lower. Okay, it's also an area of where they may spike back to. All right, the cluster, right, is the volume nodes with the POC, and it's usually the 3 cells around, right? Notice the 3 cells, right? This one happens to have point of control, volume weighted price, and it's the 3 cells surrounding these values. So I talked about it painting right back. Look, this bar closed, point of control, volume weighted price high. The bar opened right here, it rested right on the point of control and then went straight up. The next bar opened, it painted right into the cluster, right? Right around point of control. Don't forget, you got to compensate for the spread. 1 or 2 pip spread, spike down right inside there. But I want you to understand too that while the candles are working, while they're painting, there's a taper. Okay, and if you look, these values are overlapped because I couldn't spread it out and make it visible and all that garbage. But if you notice, the orders are tapered. They're coming down like this in a triangle. So in your mind, picture the bars with like triangles on the end. And inside of here, right, in the cells, we know the numbers and values are cut right down the middle. And we have sellers and buyers. We have to compensate for the spread. And the numbers are diminishing as they go here. They're tapering until you get trap trader zeroed out on the top and bottom. Okay, the idea is for them to trap people and gain money. Now, remember Bookmap, and remember that there's values in the bar. So what happens is there's pending orders in the book from Bookmap, right? And these highlight the executed orders that went off in the bar. So these are real executed orders, and these can be spoofed. They could be real orders in the book that are placed there by the dealer, and they create the zones that the candle will come to rest on. So you would have, in order for this to be the highest cluster of volume right here, there has to have been an orange stripe, let's say, in the book. And when price punches through it and comes back, then the executed orders are gone, and the remaining balance here is either tapped and taken or used as a support or resistance area on the chart to create a rejection higher or lower. All right, you guys with me? I'm jacked up on Diet Coke. I'm going 100 miles an hour, but you can watch the video in like 4 times 0.04 speed later. Not 1.5 times. I sound like I'm speaking a different language. All right, here's a view. So here's the cluster, right? Here's the volume weighted average price down here. Here's the point of control. The bar closes low, opens here, retests down right into VWAP, and then takes off to the next level. Here you go again. This one trades down to the volume weighted price plus the spread, bleeds a little, and then prints higher, right? Notice the low numbers on the high. Look, this is tapering, right? This is tapering as a collective, 68, 58, 68 going down, 4 on top, right? These numbers are overlapped. This is like 16, 14, 43, tapering down, tapering to the top. The idea is to trap people, right? 11 spread into 36 or 11 spread into 49, 48 into 49, depending on the spread. Okay? The idea is taper. That's what they're doing. That's what I want you to understand, okay? So here, orders in the book, orders on the bar. Bookmap is orders that are pending at various levels in the book. The ladder bar cells are actually executed orders. You could have an excessive amount of orders sitting on the book, but only a fraction get executed because the buyers and sellers did not meet the demand of what was placed on the book. Okay, so if a bar hits, if the dealers have 10,000 orders sitting there, 10,000 doesn't go off, the collection of the bar goes off, right? So when the bar smashes into it and you get all these orders, you add these sums up, and if it hits the level, right? Let's say there was a Bookmap level right here holding it. So what got executed on Bookmap is going to be the culmination of this bar and this bar added together, absorbed into this level, and then executed in the book. Got it? All right, in order to reject this, there's always a pip or two bleed. That's spread. Don't ignore that. That's not your concern. You know there's a spread. You know that's how they're making their money. So if you see a level in the book, or you see and price bleeds through a level and then ends up closing right there or closing right there, then you know that price went in, absorbed, the spread bled through and came back. Right? So this would be a level right here. This gray box is a level drawn in, right? Price spikes through it, comes above, closes above the level, opens here, hits that level again, 1 pip bleed on commodities and futures, and then comes right off of that level. So it basically, this level is support. Okay, you guys good? You with me? All right. So trying to tie this all together, right? You got high and low of the day. You got flat prints, box prints, M&W prints, consolidation. You got the apex, the nadir, right? You got OSBs, outside bars, spike candles. That's a withdrawal of the liquidity in the book, and the bar still has numbers being executed in it, albeit they start to taper or get small, leading into news, non-farm payroll, the book gets pulled. How do you think that candle gets flashed? The candle on non-farm payroll that flashes 100 pips is when the book, full of orders, all the dealers, nobody's home. They pull it. They pull all those orders out. The book turns solid black, and price just finds its natural, I don't know, the next group of orders. So when you have all these orders in the book and they get wiped out, and the price is sitting right here coming into non-farm, and I've showed you the video of this, and I'll do it again. Maybe 25 or 30 pips higher, there's a block of orders of dealers that are just sitting there. The book turns completely dark right at 8:30, and 1 second, everybody pulls their orders off the book. They just cancel it. They go, just like you cancel a pending order on your machine, they cancel 15, 20 levels of orders, gone. Both ways, buy side, sell side. The book goes flat, and then price comes out and just goes bam, and it gets attracted to the nearest level of orders. And then that would create your consolidation or your M print, right? Or your nadir or your apex, depending on which way you're going, and then you would get the return back to center. Then all of a sudden, all the orders start coming and flashing back in the book. That's exactly how it goes, and I'll show you the videos of it. All right, so pullbacks and short-term blocks of orders, those are the turn bars, right? That's the area that we're looking for. Impulse, immediate short-term trend, 3-hour push, instrument dependent, right? Most instruments have about a 3-hour push. If you look at the 3-hour bars, it'll be consolidation, peak formation, 1, 2, 3, 3-hour bars. And that's looks like levels. Then you'll get pullback, consolidation, 1, 2, 3, maybe 4. But when you get it, you'll get another overlapping bar, and it'll look like 4, but it's really 3.5 hours of impulse. Look at that on the 1-hour chart. Start noticing it. Right? How does the reversal come together? Reversal levels are when the book is met with proper candle structure and order flow configurations, and it gives you that perfect level. It gives you an M formation, W, an A frame, V frame, right? It gives you that 12 structure, 21 structure. All that stuff comes together at the reversal levels. Okay, so here, looking at the patterns, I want you to tell me everything you see. Don't worry about the order flow. Just type it. I'm going to pop it up, type it, and we'll talk about it. You ready? Go. It's like a pop quiz. Go. Surely you see more than that. What do you see? Really, one guy? He's the only guy sees anything? You guys fell asleep in there? Hello. Yep, thank you. Okay, what else? Yes, AR numbers. Go. Yes, what else? What else is in there? What else? What else is in here? Come on. What else is in here? I'm not talking about this flow pattern. I'm talking about, what do you see, the normal demarcations that we use, right? The stuff that we use. Right? We know that this is working itself in Asia. We know that this is the open. Look at this flat print 200 EMA. Look at this crossover and re-squeeze back. That's the stuff that we know what's going on, right? Now, shift your focus. Shift your focus to the bars. Okay, you know our demarcations are in here. The stuff that we've been talking about together for years is all in there. Okay, and the bars, they do how they do. Okay, so I want you to compare this section. This is a 5-minute chart, by the way. Okay, I want you to look at this section, and I want you to look at the 1 hour chart. This is why you need the 1 hour is the bellwether, but use whatever chart you want. Okay, so here's the 1 hour chart, same thing. This bar, I'm on the eraser. This bar is a 1 hour bar. Okay, it closes as an inverted hammer. All right, how many bars, how many of those bars are in that bar? 4? Nope, that's 15-minute. There's 12. All right, yes. Okay, so now look. Now think about this for a minute. This is where I want you to make the leap. This is the stuff that you're supposed to be seeing in your mind's eye, in your head, when you're looking at a chart. I know, brother. I'm bothering you, man. I ain't worried about you one bit. All right, so look. In order for this bar to paint, right, think about it in your mind. It opens, goes all the way green, rejects all the way down, turns inside out, and closes here. Okay, so what does that look like on this? Okay, well, we know that it turned inside out, meaning that price went, this opened right here, and at one point in time, this bar was all the way up like this, and it was solid green. Right? Then it passed the open price, went below, and turned red, and closed down here. All right? You with me so far? It's just mechanics, man. Now, this is the end of that bar. How do I know? Because this closed below that, which was the swing. Right? This is the nadir, not the apex. I really do know. I just bust chops about it for forever. Okay, this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Makes sense. Think about this now. The bar opened, went all the way up to the top, rejected, painted all the way back down, maybe beat it a little bit higher, and then they flushed it through and closed below. That's what this looks like in 12 bars, but it's stated as a hammer right there. Okay, now, 1 hour chart. You got a nice flat print. Prices above the moving averages. The moving averages are turning flat on a higher time frame. Okay, what is that setting up for? There's a couple possibilities. A 12, a 22, flat print, box top. I was going to write box top. I can't write with this thing. Okay, box top. Think about that. Okay, now, you got a 1 hour inverted hammer hitting the high of the day area at the daily open and the AR rejection. These are all demarcations that we know and I have taught for the last 12, 13 years and have traded for the last 22 or 23 years. Okay, so now you're starting to see how it comes together. Okay, we're trading below the open. Remember I talked about the AR numbers, the high AR and the open makes a zone. Look at this as a zone. You could almost guarantee you're going to get something going down over here. Okay, 1 hour auction levels. You got an auction, high and low. I have nothing. Dealer breaks lower, comes back, retests the level. The book flips the minute this candle executes and takes out this entire level and closes below the moving average. This looks like railroad tracks to the long side, right? This hammer goes up and it's solid green. It's trading above here, but it's not trading above the highest swing flat print auction level. It's not trading above the high of the day. It's trading below the previous swing high after it just took out the swing low of the auction book. Right? So in the chart in the very beginning that I pop quizzed you, this would be that swing low, or this would be where it took it out, and this would be the previous swing low, this level, right? Sorry. So now when this was taken out, the dealer confirmed that he ate these orders up out of the book. He gobbled them up, came back and retested the level, and then he was gone. Notice that this is, look, 1, 2, this doesn't count. It's inside shadow, 3. This pulls back, 1, 2, 3, impulse. Pulls back, 1, 2, 3, push. 3 hours of push in the session, right? It changes at the end of the day, but it's basically 3 hours of impulse. Look at this right here. 1, 2, 3, flat. There's pushes of about 3 hours on a 1 hour chart. So if you're in something and you're looking to get something out of it, and you're looking at a 1 hour chart as your guide, and you get in a little late, I got to erase all this, sorry. Brutal. Okay. Sorry, it's so clumsy, man. I don't know why they can't make it easier. Anyway, it's either me or them, and I'm going to go with it's them, right? It can't be me. It can never be me. All right, so look, this is the bar that we're talking about. So what are the two best trade places? Right? Close of the hammer, or if you go pending, top side. So you have a trade from here to here. If you went sell limit into the box, or you have a trade from here to here. Okay, let's look at it. So when price goes up and breaks back down and fails to take out the high level, you would refine the entry off of this wick, these bodies, and I'm going to talk about the positions of these in a minute. All right, that 2BR is a 2-bar reversal. It's not a big deal, but I want you to notice how the points of control are. All right, so if you executed sell limit order resting on the day open right here, just in front of it, you got taken in clean right here off of a refined entry that was drawn here, pressed out into time. Price came down, took out this level. The book is short, looks like a catch-up bounce back into here, and then you get that shift. Or if you execute it here, where's the refined entry here? Right, I would aggregate these bars. Let me be clear on how to do this. Okay, when you're looking to refine the entry, remember we said that candles paint back into a point of control, and that the wicks are the rejection of where the point of control is located. Okay, so wait a minute. If this wick is telling me that this dude printed the point of control right there, right? It's on a larger shift bar, so there's more order volume. Look at the stacks, right? Look at the stacks. There's more order volume in a big bar because it's longer and it has more volume in it. So now, if I'm going to use that as a clue, and I don't own the tool to tell me where the points of control are, right? This is where my refined entry came from, man. This is like history in the making for me anyway. Okay, so I started realizing that I'm going to use these wicks and aggregate on these bodies to get a zone. So I'm going to take, after the shift bar, I'm going to take the first rejection and extend a box around this area and stretch it out into time. Okay, there's a lot of points on this chart I want you to see. So I want to aggregate the top of the wick and maybe the close of the body. And that would give me this, roughly. Right, and you know I can't draw. Okay, so now I'm going to take this box, let's say for argument it's 10 pips, and I'm going to draw a line halfway through, and I'm going to either get my orders in here, aggregate it out front lower, or I'm going to go all in at mid box, stop above the box. So if I get aggregated here at 5 and I'm using a 10 pip stop, I'm going to be 5 pips above the box. Now, where did the apex nadir thing come from? Go back and look at this now. Tell me the answer. Tell me why this is so important. And if you don't see it, I'm going to point it to you in like 2 seconds. Anybody? Can I get some love? All right, look, right there. That's how the apex and nadir works. Most of the time, the point of control will point or paint right at the very bottom of the apex or the very top of the nadir or whatever, vice versa. This is the bottom of the nadir, top of the apex. Sorry. All right, now look over here, man. There's 3 points of control lined up with this thing. What does that mean? Orders were in the book and they were actually executed at the highest amount of volume sitting on the book, because we know the book spoofs the levels, but you can't lie on the bar. The bar is actually traded volume. Okay, so that's the anatomy of a turn. Turn is where a turning point on the chart is where the POCs cluster together and they start to come down. And then they repeat these levels in the book. Draw this out into the future, and it's going to give you my zone roughly of where we're looking to sell side. So what happens? Price vectors up, right? Remember, we're looking on that 1 hour hammer bar. This is all within the confines of a 1 hour bar. This happened in 60 minutes, 12 5-minute pushes. But you're sitting here going, watching this stuff go up and down, you're freaking out, and the whole time it's a hammer just forming off of the high rejection. Don't let their BS get you. All right, so shift bar to the high, right? And then when you're back to this 1, 2, 3, look at these POCs. To get through levels, right? They have to execute high, and then to jump through this piece right here, execute high. Notice the wick hits that POC and closes the body at the open right there. All right, notice these POCs all sitting on top of each other and they shift right through. They got to go high side. All the volume has to eat through this. The most volume exchange is right there on the cluster. Then what do? They reprint on top of each other. Rejection high, hitting the stops above here. And then they come back into the range. Notice that on the collection of points of control, watch this. Take the collection of the points of control, the collection of the points of control, and there's your high side zone. Now go back to the auction theory. If this is the swing low and this is the swing high, the most recent one in the book that represents 15, 20 minutes ago on the chart, it's still relevant. Okay, dealers run it up, high side points of control, trying to attract people to go long. People do go long. They fail to take out the swing level, right? What are the options here? If I could draw straight for once in my life, what are the options here? And what are the options here? The options here are come back, break lower, retest, or get above this previous swing, which means they have to fully absorb these last 3 swing points of control that are executed in the book. And we know there was orders there because the stripe was in the book, but they actually went off right about the same price point. So in order for them to get those orders off, there had to be something more there at the highest volume exchange. There had to be something there in the book that had value, that meant something. It was strong enough to turn price back down, and it held price below the previous swings, right? These numbers, if you look at them, are more significant than all the other numbers in the book at that time. Buy side tried to run it back up, and these POCs held that level and created a huge shift down. Now, there's the exact crap I've been drawing for you for the last 4 years or since 2014 that shows you in graphic form that it's this or it's this. They have to take out the swing level by absorbing that. They have to take out the swing level by absorbing this. If they can't take this out, that's a failed buyer's auction. Sell side takes the book by passing through the nadir. All right, that's it. Okay, then our demarcations are here. We got AR numbers, we got opening price, we got flat print moving average, right? The 200 represents higher time frames. The water represents intraday, and the 13 represents on this chart 5-minute closes and 5-minute print, right? 13 is close to price, 50 is the balance line above or below. But when you get a balance line painting flat, you got a flat print. When you got a balance line painting up, trend is up. I got to say it, when you got a balance line painting down, trend is down. That's where the 50 bounce trade comes from. And you'll be surprised to know, if you classify this as a 50 bounce trade, the highest volume exchange was right on the 50. For all my 50 bounces out there, Sean. Why? Because they had to stop it right on the 50 to get the bounce trade to work. They knew we were looking at it. They were working with us. Look right here. Highest volume exchange right on the 50. Pulls back. Then they break through with a higher point of control. Shift it, higher point of control. Why so high on the bar? They got to eat this, they got to eat this, and they got to get through it. So the volume starts pouring in, and they hit it at the top. Then they flat print it. They got to get through all this. They got to get through the 200 pending orders, whatever's there. They pour it into the book, and then they got to cap it at the top. That's an example of capping. Capping. High side point of control, rejection. Capping in the book, right? Capping down from the downside. A low side point of control, push it back up into a hammer. So if you can imagine these things from the patterns, which we've been doing for years without these tools, what do you need the tools for? You need to have a deeper understanding what the hell you're looking at. That's the business. The business is not a bunch of bullshit on the chart that tells you like, oh yeah, there's a lot of volume traded there. Steve said so. It doesn't matter if I say it. You have to make it your own and own it. It's got to be something that you understand at a deeper level. That when you look at it, you go, okay, this apex nadir thing this guy's been talking about for the last half of his life, now I understand it. There's high volume there. They do some accumulation, right? These are failed auctions in here, right? And what's inside of a failed auction? Accumulation. A failed buy side and a failed sell side auction is accumulation until it's not. When they have the numbers in their favor, they shift and retest. That's how I came up, refine the entry. Because I started looking at that, realizing, man, these points of control got to shift through here to eat through this. And then the next candle repaints right about where the POC is. What do you need a POC tool for? You're smarter than a blue box, right? Well, I hope you're smarter than some yellow crap on a chart. When price prints and pushes back down, you just take this candle and you draw your box. And you take an aggregate. You could take an aggregate of the bodies, right? A spinning top like that, POC and VWAP are right in the middle of the bar. So this is how I came up with aggregating that area, right? I got this coming out. That's point and control. I like this here. It's a small body. I'm going to take the bodies out on average. I'm going to draw a box, and they get a clean retest right into the box 15 or 10 minutes later, and then that happens to be the trade that when, if you entered from the top side, same thing here, same principle, right? How would I refine this entry? I would take an aggregate of these. Exactly, right? There's a wick here, a little wick here I would encompass, right? This just so happens to be point of control. It's in there, bodies, wicks. I would take this level down to the bottom of this wick and I would stretch it out into the future of time, and I would get a perfect V pattern, which means that they took out the level, swung back, and then they flat printed, and then they give me the shift. Yep. And so people are mentioning that's literally, I don't want to say your name, brother. That's literally the pattern he looks for every single day. Crazy seeing it laid out with all the POCs and VWAPs and stuff going on. That's it. That's the pattern. So if you're looking for this, this is the best place to trade because this is a confirmed sell side auction by taking out that. But if you understand what you're looking at, now when you get, I mentioned it, if I've said it once, I said it 100 times in the last 2 or 3 years. If you get the day open, the AR numbers, and all that stuff lining up, that's a zone. Price open and AR, if you get price breaks below, retest, can't get through that day open, that's your area to execute. Then you're going to be in right at the shift bar and you're going to be up. There's a difference of a 64 versus a 42 being conservative, right? If you entered here on the close of the hammer on the 1 hour chart, this is where the 1 hour chart closed, right? This is the 1 hour close, 12 5-minute bars later, and it created this big inverted hammer. So if you overlaid the 1 hour chart right here, right, this is what you got, right up to that high right there. So if you executed right there, you're cool, but you had a little draw. So if you waited for the 1 hour to close and jumped over and then started looking at the 5-minute, refine the entry for yourself, you could have got in right here. And you would have had some type of inversion You got to go mid-box because remember the tapering. Here, clear this off. I can tell you there's some zeros right there. Look how low, 0 there, or 9 or 0. I can't see it. I'm blind. Right? 0. Trap traders, right? This number aggregated here, nobody took it. Stuck. These guys are stuck at the very top of the bar going long. All right, understand? So then now, this would be edge and wedge type stuff, right? Here's your high side, top edge, into a wedge, breaks out. And if you took the trade right when the hammer closed, right there, your execution's in here. It's pretty damn good. It's pretty close. And you get that nice shift down, and you get a 3-hour push, and you got about 42 pips on the table. And this is in, by the way, this is in futures. I think it went for like 60 in the Forex, went a little deeper. It's just the difference between the futures contracts, more conservative, but you can't see the order flow in the Forex. You can see it in the future, same instrument, futures contract. All right, man, it's 56. I'm going to skip through the rest of this. Let me see. I had same thing, just refining, talk about it. All right. Okay, here we go. Let me just read these last slides off to you. I'll cover this. This is the anatomy of a reversal the other way. Same thing. I'll cover it next week. I'll start with that. I just want to talk about real quick, right? POCs of prior candles become the next candle support and resistance. You know, I hate that word because it's man-made, but yes. We use the information to refine the entry. This is how I created the zero entry trade. Looking at that and making the observations and projecting it forward is how I created a zero entry trade. What's so great about it? It's got little to no draw, straight to break even, and then into profits. Literally within a few bars, you're in where you need to be. You're using the highest probable reversal point within a candle to lean on by looking at the body closes, the aggregate. You're leaning on the point of control, whether you realize it or not. Okay, so now here's my challenge to you. Do some homework on it, okay, and get it into me. And then what I'm going to do is I'm going to pull the POCs on the charts and I'll overlay them next week together and we'll look at it. You could do any pair you like, but I can collect the data on the 6E, which is Euro, EU, and the 6B, which is GU, and I can collect it on a couple other instruments. But if you just stick to GU and EU for a drill, I can get those easily. Download the data as it prints, and then just take the screenshots for us to look at next week. If I don't get any, I won't do it. So draw in your mind some yellow slashes on the bar to give me where you imagine or the imaginary points of control that you don't have access to. And don't be, if you have it, don't be sending me some shit that's like perfect. I'm like, oh man, this guy's a psychic, clairvoyant. I'm going to come over there asking you when I'm going to die, if I'm having another baby. I'm asking you a bunch of questions. So don't be all clairvoyant on me. Really do it. Try to imagine where they are. All right? Just slash it and think where they might end up. Right? And like I said, I have the data easily accessible to GU and EU. It's because I collect it for myself and I look at it. All right? So see some comments in there are funny. See how close you can come? And I'm never going to use your name. I'll never call you out, never trash you, never embarrass you. You know how I do business. I'm not trying to embarrass anybody. I'm trying to get real life examples because I guarantee you, collectively, everyone's making the same mistake. And that's the point of it. If someone sends it in to me and I put it out there, I'm not going to go, oh, JR did this. I'm not going to say that. All right? Try to do it like today's Wednesday. Do it like Thursday, Friday, or Monday. Get it into me because I don't just, believe it or not, I don't just pull this out of my butt 20 minutes before on Wednesday. It's a lot of work to talk to you guys for an hour. More than you know, but I love it. I love it at the same time. I love it and hate it at the same time, if it makes any sense. It's a labor of love. All right, so look, send me in some examples of imaginary POCs, mark it from tonight through the rest of the week, and then get it to me by Monday. And then I'll hold it up and I'll actually overlay the POCs on there and we see what we got. All right, that's your homework assignment. Send me some love, man. I will see you guys next week. Don't forget, if you're not at this point of looking at the points of control, then send me the regular drills and stuff, all right? Just send me something. If you send me something, I know you're engaged and I know you're trying and I know you're working the process, man. And I could tell you that there's a group of people that are having success, and I could digitally search them and I can tell you that I have hundreds of markups from them. I have the drills, I have the high-low, I have the strings from their trades. I have those things, and that's why they're having success. I didn't make this stuff up. This is what works. This is what was done to me. All right? Do the work. You'll have the success. Good night.